Okay, you've heard it a million times, right? It's the first piece of investment advice anyone ever gets. That one golden rule: buy low, sell high. I mean, it sounds so simple, so obvious. It just feels like the only logical way to make money. But the crazy part is, our own brains seem to be wired to do the exact opposite. As this Reddit user points out so perfectly, we see a price shooting up and we get FOMO, we jump in. We see it falling and we panic, we sell. The conventional wisdom says our job is to fight that very human impulse. But here's the big question for today. What if that conventional wisdom is totally wrong? What if chasing the winners, buying the stocks that are already going up, is actually the smarter play? We're about to dive into one of the market's biggest and most fascinating paradoxes. So let's just make sure we're on the same page about this rule we're about to tear down. Buy low, sell high. The whole idea is to be a bargain hunter. You're looking for companies that have been beaten up, things that seem undervalued, so you can scoop them up for cheap and just wait for them to bounce back. We all have this dream, right? We want to be that genius who sees a stock that's tanked and thinks, aha, this is my shot to get in on the ground floor. But the cold, hard reality of the market is, well, what looks cheap often just gets cheaper. Trying to catch that falling knife, as they say, is a really good way to get hurt. And this isn't some new idea. The legendary investor William J. O'Neill was talking about this decades ago. He saw that most of us, pros and newbies alike, are just psychologically drawn to buying stocks that have fallen off a cliff. It feels safe, right? It feels like you're getting a discount. But as he found out, it's one of the most common and costly traps in investing. So why? Why is this strategy such a trap? Well, the answer isn't in the balance sheets. It's in our heads. One of the main culprits is a little thing called anchoring bias. Here's how it works. We see a stock that used to be $50, and now it's only $30. Our brain gets stuck, or anchored, on that $50 price tag. We think that's its real value. So we buy it at $30, and even if it sinks to $20, we hang on, just praying it'll get back to that $50 peak. We're making a decision based on the past, not on what's happening right now. And this is where things get really interesting. This flawed thinking leads us directly to what O'Neill himself called the great paradox of the stock market. Just listen to this, because it turns everything we think we know upside down. The very stocks that look scary, the ones that seem way too expensive and are hitting new highs, those are often the ones that just keep climbing. And those so-called bargains, they usually just keep on getting cheaper. All right, so let's really dig into this paradox, because it's not just some quirky observation. It's actually the foundation for a very real, very well-documented investment strategy. And that strategy, it's called momentum investing. It basically takes O'Neill's paradox and turns it into a system. Instead of buying low, you buy high. You actively look for stocks that are already in a strong uptrend and you hop on for the ride. The whole idea is that winners tend to keep winning and, well, losers tend to keep losing. Now, I know what you might be thinking. This sounds kind of reckless, doesn't it? Just chasing whatever's hot. But the historical data, oh man, the data tells a completely different story. And this is just incredible. Take a look. This chart breaks down the best performing investment styles decade by decade, going all the way back to the 1930s. See that orange color? That's momentum. It was the #1 performer in 5 of those 9 decades. And get this, it beat the overall market in every single one. And all that consistent winning, decade after decade, it really, really adds up over time. You can see it right here. That bold blue line, that's a global momentum strategy. From 2001 to 2016, yeah, it had some sharp dips, but look where it ends up, way, way on top of everything else. So here's the bottom line. When you look at risk versus return over a 40-year stretch, momentum delivered the highest returns, period. Yes, it was a bit of a bumpier ride, it came with more risk, but that performance advantage is just undeniable. The data isn't just suggesting this works, it's practically screaming it across a century of market history. This is not a fluke. Okay, so if the evidence is that strong, you have to ask the next logical question. Why? What is the engine that's actually driving these trends? Well, spoiler alert, it's us. It's human nature. So why does a winning stock so often keep on winning? It's not magic, and it's definitely not random. It's actually a cocktail of predictable, deeply human biases that affect how all of us react to what's happening in the market. It's like this powerful chain reaction. First, we're surprisingly slow to process good news.
So a stock just sort of drifts up over time instead of jumping all at once. Then, as it rises, the herd shows up. Everyone sees it's a winner and they pile in, pushing the price even higher. While that's happening, our confirmation bias kicks in, so we start looking for any reason to justify our brilliant decision. And then there's the kicker, the disposition effect, which means we sell our winners way too early to lock in a small profit, while we stubbornly hold on to our losers forever.
You put all of that messy human behavior together, and what do you get? A powerful feedback loop. As these researchers put it so well, momentum becomes a self-fulfilling prophecy. Its strength comes from the simple fact that we all tend to act in these predictable ways.
Okay, so if the golden rule is flawed and momentum is a real phenomenon backed by a century of evidence, what are we supposed to do with all this information? How can this help us build a better way to think about investing?
William O'Neill had this brilliant, simple analogy to explain the logic. Imagine you own a dress shop. Your red dresses are flying off the shelves. You can't keep them in stock. But the yellow ones, they're just sitting there, collecting dust. When it's time to reorder from your supplier, what do? Do you order more yellow dresses just because you can get them at a bargain price? Of course not. You order more of what's actually selling, the red dresses. You cut your losers and you double down on your winners. And that simple logic gives us a whole new framework. First, you identify the leaders, strong companies that are already doing great. Second, you don't buy them on sale. You buy them precisely as they're breaking out to new high prices. And third, and honestly, this is the most critical part of the whole thing, you have a strict, non-negotiable rule to cut your losses. If a stock you buy falls 7 or 8%, you sell it. End of story. No hoping, no waiting. That's what protects you when you're wrong. You know, when you really think about it, challenging buy low, sell high isn't just about one investment strategy. It's about recognizing that so much of what drives the market isn't cold, hard logic. It's predictable, messy, human psychology. And it leaves us with one heck of a question. If this foundational golden rule is built on such a shaky premise, what other market truths have we been taught that maybe, just maybe, deserve a second look?